OPEC Plus technical panel to meet on February 5 and 4 to discuss coronavirus impact. Nigeria's Manufacturing Purchasing Managers Index marginal in January. And South Africa's ABSA PMI falls further in January. Thank you for joining us and welcome to Business Incorporated. I'm Chimizie Obi. We'll begin the show with the latest PMI numbers from Nigeria and South Africa. Nigeria's Manufacturing Purchasing Managers Index, which expanded but at a slower rate for the 34th consecutive month, dropped marginally to 59.2 in January. According to the latest data from the central bank, the reading represents 1.6 points decline in contrast to the 60.2 PMI reading recorded in December 2019. Similarly, the composite PMI for the non-manufacturing sector stood at 59.6 points in January, indicating expansion for the 33rd consecutive month. However, the non-manufacturing PMI, which dropped by 2.5 index points, grew at a slower rate when compared to 62.1 reading last December. 11 out of the 14 sectors surveyed in the manufacturing sector recorded expansion, while all the 17 non-manufacturing sectors surveyed recorded expansion as well. And South Africa's seasonally adjusted ABSA Purchasing Managers Index slipped deeper into contraction territory in January as employment and inventories fell despite a recovery in new sales orders. The index, which gauges manufacturing activity in Africa's most industrialized economy, fell to 45.2 points in January from 47.1 in December, remaining below the 50-point mark, separating contraction from expansion for a sixth straight month. And the intraday numbers amongst markets we track here in Africa were not looking good at intraday. Nigerian index was heavily down 1.22% at midday Nigerian time. The South African JSE index was also down 0.27%. Egypt tilted northwards but marginally, while the Nairobi Stock Exchange ended Friday negative. In the Middle East, Dubai stock market rose, led by gains in banking and property shares, while other Gulf bourses were down as investors await corporate earnings announcements. At intraday, the Dubai index gained 0.18%, with blue-chip developer Emma Properties adding 1.3%, while Dubai Islamic Bank was up 1.1%. The Abu Dhabi index was down 0.77%. Saudi Arabia's benchmark index traded flat as financials and energy stocks moved sideways. RG Bank was up 0.5%, whereas oil giant Saudi Aramco slipped 0.3%. Qatar's blue chip index lost 1.07%, with most of its stocks in the red. Qatar Islamic Bank fell 2.1%, while Qatar Insurance eased 1.9% after reporting a marginal rise in annual profit. In Europe, markets were muted in early trade as investors appeared to brush off concerns over the UK's departure from the EU, which took place on Friday, and the latest coronavirus development. But let's get more of the trend from the European space from Chelsea there. Hello, Chelsea. Good afternoon. Well, Chinese stocks plunged today as markets reopened after the Lunar Year holiday. How are European markets reacting?
Panic selling that we really saw in Chinese stocks earlier today hasn't really bled over into the European markets. As you mentioned, the Chinese stocks fell about 8% earlier in the session, and that's really in large part because the markets have been closed since January 24th in China for the Lunar New Year holiday. So they weren't really able to absorb the information last week as the number of cases and the number of fatalities started to surge, and we saw this global sell-off in stocks. Chinese markets were closed, so Chinese markets are really playing catch-up to all of this news we've seen here in Europe. The picture hasn't really changed much for investors. There hasn't been a lot of information indicating that the spread of the virus is starting to accelerate. So I think investors are taking a little comfort in that, and also some moves on behalf of China to sort of backstop the economy is also making investors feel a little more confident.
All right, we've heard the Chinese central bank say it will inject about $174 billion into markets and take other steps to help the economy and stabilize the markets. Do investors think these steps will work?
Investors are certainly seeing this as a good step on behalf of Chinese authorities. There had been a lot of concern about how Chinese markets would trade today when they reopened, and I think the $174 billion that the Chinese central bank is injecting into the market are certainly helping to prevent more panic throughout global markets. They've also taken a lot of other steps that will hopefully help markets from having too much volatility over the next several days. So they're curbing short selling. They're taking some steps to restrict futures trading. So these are all very short-term solutions, though. Investors are really starting to think about how the Chinese authorities are going to support the economy. And to do that, they're going to need to do more policy steps. They're going to need to do things like cutting taxes, lowering interest rates, increasing spending, and that's not really steps that the Chinese authorities have taken yet. Investors are also starting to look at how other central banks might respond to this. There's an increasing market confidence that the Federal Reserve might also have to react if this outbreak does start to spread throughout the global economy and weigh on growth. So I think investors are certainly happy to see the Chinese authorities taking steps to curb volatility in the market, but in terms of containing the economic fallout, it's going to take bigger steps on behalf of policymakers.
Where you are, the country again ran the world's largest current account surplus in 2019. That's according to a new estimate from the German Economic Institute, IFO. Will this renew pressure on Germany to boost stimulus to counter stagnant growth?
It's certainly going to bring this back into the conversation. Last year, Germany was under a lot of pressure to boost spending, to boost stimulus as the economy has basically stagnated here in Germany and more broadly in Europe. And those conversations sort of got overshadowed by bigger, more immediate concerns, trade war, now coronavirus. But I think this data point is certainly going to put the spotlight back on Germany's current account surplus. It rose to almost 300 billion last year, according to this estimate. And the concern with that is that Germany is receiving a lot of money and it's not really putting anything back into the world. So it creates a lot of imbalance, but it also prevents growth in Germany and in Europe more broadly at a time when monetary policymakers, so central bankers, are coming up to the point where they don't see much more of a return from things like quantitative easing. So Germany is under certainly a lot of pressure to boost spending to help boost growth for the broader European economy. And this data point will certainly return attention to that conversation.
All right, Chelsea, thank you for those updates. It's a new week, so we hope for the best as the week rolls by. Thank you and enjoy the rest of the day. In the meantime, in the UK, the IHS Market Manufacturing PMI data is out, and it shows the business conditions in the UK manufacturing sector stabilized at the start of the year as political uncertainty declined and the domestic market strengthened.